In this video, we will explore about arbitrage using options and the principle of put-call parity. You can think of arbitrage as a way to make a profit when the market price of an option is different from what its actual fair price should be. This entire concept is built on a special relationship called put-call parity, which connects the prices of call and put options that have the exact same strike price and the same ending date. Just like we can find profit opportunities when futures contracts aren't priced correctly, we can do the same with options. The rule of put-call parity acts as a guide to show us how call and put prices should relate to each other. However, for this rule to work, two conditions must be met. Both options must have the same strike price and the same time left until they expire. It is also important for you to remember that this principle only works for European style options. To understand how this works, we use a specific formula. It looks like this: C plus X times e to the power of minus RT equals P plus S0. In this equation, C represents the price of the call option and P is the price of the put option. X stands for the strike price and S0 is the current market price of the stock. The letter R is the interest rate, while T is the time remaining until the options expire. We can use this formula to find hidden profit opportunities. If we already know the current stock price and the price of a call option, we can use our formula to calculate exactly what the fair price of a put option should be. Once we have that fair price, we look at the actual price the put is trading for in the market. If the market price is not equal to our calculated fair price, we have found a signal for an arbitrage opportunity to make a risk-free profit. Let's look at a real-world example to see this in action. Imagine a stock is currently trading at 1,251 rupees. We have a call option with a strike price of 1,240 rupees that expires in 1 month and its price is 47.50 rupees. The current interest rate is 8% per year. Our goal here is to figure out what the fair price should be for a put option on this same stock with the same strike price and expiry. To find the answer, we start with step 1 by putting our numbers into the put-call parity formula. This calculation gives us a fair price for the put option of 28.26 rupees. In step 2, we compare this to the actual market. We see the put is actually trading at 23.15 rupees. Because 23.15 is less than 28.26, we can conclude that the put is underpriced, which means we have identified a clear arbitrage opportunity. Now that we have found the opportunity, we need an action plan. To capture the profit, we must perform 3 actions at the exact same time. First, we buy the underpriced put for 23.15 rupees. Second, we buy the actual stock for 1,251 rupees. Finally, we sell or short the call option to receive 47.50 rupees. Executing these together is the key to the strategy. Let us look at how much money moves in and out at the start. Our cash outflows involve buying the stock for 1,251 rupees and buying the put for 23.15 rupees, totaling 1,274.15 rupees. Our cash inflow is the 47.50 rupees we get from selling the call. This results in a net cash outflow of 1,251 plus 23.15 minus 47.50, which equals 1,226.65 rupees. We will assume we borrow this amount at an 8% annual interest rate. Now, let us see what happens in scenario A if the stock price rises to 1,275 rupees by the expiry date. We sell our shares for a cash inflow of 1,275 rupees. The put option we bought will expire with a value of 0. However, our sold call option is now in the money, which results in a loss of 35 rupees. We also have to repay our loan, which has grown with interest to 1234.86 rupees. Our final result is 1275 minus 35 minus 1234.86, giving us a net profit of 5.14 rupees. What if the stock price falls instead? In scenario B, the stock drops to 1200 rupees. In this case, the call option we sold expires with a value of 0. We sell our stock for 1200 rupees, but our put option now gives us a profit of 40 rupees. After we repay the same loan amount of 1234.86 rupees, we are left with a net gain of 1200 plus 40 minus 1234.86, which again equals 5.14 rupees. When we check our results, we see something very interesting. Our net gain is exactly 5.14 rupees regardless of whether the market went up or down. This validates our strategy because the profit of 5.14 rupees is the exact difference between our calculated fair price of 28.26 and the market price of 23.15. This shows that the principle of put-call parity works to lock in a consistent gain. While this sounds perfect, there are execution difficulties and risks we must consider. This strategy requires us to buy and sell the stock, the put and the call all at once. If there is a delay in any part of the trade, known as execution lag, we might miss the profit. There is also leg risk, where failing to complete one part of the trade leaves you with an unprotected position. This could lead to large losses if the market moves against you, so precision is vital.